Hey everyone, this is Ronak Ahuja. I welcome you all again. Are you a business that has recently set up or recently started to make profits? Or are you a business that has turnover or sales of up to rupees 3 crores during the financial year? If yes, this video is for you. Now, calculating taxes for your business can be very difficult and cumbersome in case you're not aware of the tax rules. There are specifically two ways to calculate taxes for your business. The first way is the normal way, in which you maintain a detailed set of records of the expenses you incur and the sales you make during the financial year. This means you need to maintain an entire set of records of the expenses that you have incurred during the financial year or the sales you have made during the financial year. This process can be very cumbersome and a little expensive too. Now you have a second option. The second option involves calculating taxes just as a percentage of the entire turnover that you make during the financial year. That is, by simply applying a percentage on your total sales, you can arrive at the profits during the year. And the profits that you arrive at can be used to calculate taxes for your business. Yes, it's that simple. You just need to apply a percentage to the total turnover, that is total sales that you made during the financial year. Further, in this scheme, you won't be required to maintain a detailed set of records either. You just need to maintain a detailed set of records for your sales. This method is called calculating taxes as per the presumptive taxation scheme. And this is what is going to be the subject of our video today. Now, before we try to understand how presumptive taxation scheme works, let's first try and understand how income taxes are generally calculated. First of all, we try to calculate incomes under the all five heads of income. That is, income from salaries, income from house property, income from business or profession, income from capital gains, and income from other sources. Once the incomes are calculated under each of the five heads, then we sum all these incomes and we arrive at the gross total income. So, the gross total income is the first step of calculation. We add all the five heads of income to arrive at the gross total income. Once the gross total income is calculated, then we reduce the deductions that are applicable to us under Chapter 6A. For example, all the payments that we make to life insurance or Mediclaim or many other deductions that are allowable under Chapter 6A, we are allowed to get it reduced from the gross total income. After deducting these, we arrive at the net taxable income. Now, the tax rates are applied to this net taxable income to calculate the overall income tax. So, the net taxable income is what we try to calculate before we apply the tax rates to it. Now, let's focus on how we calculate incomes under the head business or profession. Incomes under the head business or profession is calculated as follows. First of all, we calculate the total sales or total revenue of the business. Then we calculate the total expenses of such business, and then we identify those expenses that are allowable as deductions under the income tax provisions. Now, there are various provisions under the Income Tax Act that help us determine whether an expense is allowable or disallowable under the Act. Now, this is the most complex part in the calculation of incomes as per the business or profession. Now, all the expenses are first tested as per the provisions whether they are allowable under the Act or not. Now, only those expenses that are allowable under the Act will be reduced from the total sales. This adds to the complexity of calculation of incomes under the head business or profession that deters the small taxpayers to calculate incomes as per the normal provisions. Thus, for this purpose, the government introduced a special scheme. This scheme was called the presumptive taxation scheme. Under the presumptive taxation scheme, you calculate profits as a percentage of the total sales. Now, what does this mean? The first step remains the same. You'll have to calculate the total sales of your business first. And then you simply apply a percentage on those total sales, and the resultant figure will be your taxable profits under the head business or profession. Yes, it is that easy. And that's why, just to help these small taxpayers, the government introduced this scheme. Now, there are some other problems also that was being faced by the small taxpayers, and hence the PTA scheme, that is the presumptive taxation scheme, was introduced. The other problem was, if your profits go below the specified limit, then in such a case, the small taxpayers were supposed to have their books of accounts audited under the Income Tax Act. That is, they were supposed to get their accounts audited as per section 44 AB, which is the provisions relating to the tax audit. If the profits fell below the specified limit, the small taxpayers were required to get their tax audit done. This added to their burden of additional cost. The second thing, as we just discussed, was the complexities involved in the calculation of incomes as per the normal provision. Now, the presumptive taxation scheme for businesses with turnover of up to rupees 2 crores during the financial year, their total income from that business would be 8% or 6% of the total sales made during the financial year. This means you simply need to multiply 8% or 6% to the total sales that you made during the financial year. Now, the first question would be whether it would be 8% or 6%. Now, that would depend upon the manner in which you collected your sales. That is, the sales that you collected by way of banking channels, that is, either by way of NEFT, IMPS, or any other banking channel that has been set up by the banks, then in such a case, the percentage that would be applied would be 6%. And on such portion of the sales that you have collected in cash or in a manner other than the banking channels, then the percentage that would be applied would be 8%. Now, moving on to the next part. In case your turnover is greater than 2 crores but is up to rupees 3 crores, you will still be eligible for this scheme. The manner of calculation would be the same, and the rate of percentage would also be the same. That is, 8% or 6% of the total turnover that you made during the financial year. But here, there would be one additional condition that you would be needing to satisfy. And that is the total collection in cash, that is, the total sales collection that you have made during the financial year should not exceed 5% on the total sales made during the financial year. This means the total sales collection in cash should not exceed 5% of the entire sales collection you made during the financial year. In case you collect the sales receipts in cash exceeding 5% of the total sales collection, then you won't be eligible to opt for this scheme. This scheme that we just talked about is for businesses and not professionals. However, we have separate provisions for professionals as well. Let's quickly move to that. Now, for professionals who are engaged in providing services such as legal service, accountancy service, medical service, engineering service or an interior designing service, in such cases, if they have turnover of up to rupees 50 lakhs during the financial year, their total income would be 50% of the gross receipts or total sales during the financial year. In case your turnover is from 50 lakhs to 75 lakhs, then in such a case, your total income would still be 50% of the gross receipts only if you satisfy one additional condition. And that is, the total sales collection in cash should not exceed 5% of the total sales collection made during the financial year. If you satisfy this condition, then in such a case, this presumptive taxation scheme would be applicable to you. Now, who are the persons who are ineligible to opt for these schemes? In case of businesses that are engaged in agency business or have an income that includes commission or brokerage income, then in such a case, they won't be allowed to opt for this presumptive taxation scheme that is applicable to businesses. Further, this presumptive taxation scheme of business would be applicable only to individuals, HUFs, and partnership firms who are a resident. This means this is not applicable to the non-residents, nor the companies. So, in case you're a smaller business that satisfies the criteria that we just discussed, do try to make the most of it. In case you couldn't follow, please drop us a feedback in the comment section or mail us at talklevies@gmail.com. Thank you and stay tuned for more videos.